Welcome to another Market Matters weekly video. Back after a 1 week hiatus. Apologies everyone for no video last week. I was actually overseas, so we couldn't actually do one. So I stress my apologies. Okay, joined by James again, our Chief Market Strategist here at Market Matters. Now James, I think the question on everyone's lips at the moment is, Christmas rally. We've seen the market get up to 5,600 or close to it. In the reports you've been talking about the market goes higher before it goes lower. Just wanted you to really reiterate that view and explain that view and what you're anticipating over the coming weeks, I guess with the market.
Yeah, so since Trump took the US presidency 5 weeks ago, Dow's up over 1,600 points,
yep.
So 9%. Aussie market's up 5.6%, so it's been on a tear, there's no doubt about that. I guess the next question is, what do we expect into December, and what do we think at the start of 2017? So, we're clearly in the camp of higher prices or higher levels in the market at the back end of December. We think probably get to 5,700 by the end of the year. I know it's a fairly bullish call, but you've got to understand the level of pessimism that's played out over the last 12 months. Fund managers are very heavily weighted in cash at the moment. They're chasing some of those areas of the market that have been unloved. So our call is 5,700 at the back end of this year. If we're looking at the US market, the US market could potentially rally another 10% from here. If the Aussie market corresponds with that or correlates to that. Now, we haven't had a huge correlation in the last 12 months, but if it correlates to that, then we can get up towards that 6,000 level. Then we should turn a little bit cautious, Nick.
Okay, fantastic. And this sort of blow-off top you've talked about, we're not quite seeing that yet. There is, you'd have to probably say there's a little bit of FOMO going on in the market at the moment. People are chasing it. Is this like what you would call the start of a blow-off top? Or I guess you can never completely be incredibly accurate with these things. What are you seeing in that front?
One of the things I look for is that that level of complacency where people think the market can't fall. So we're starting to get a lot of bullish commentary coming out of the market. There's some bulge bracket brokers, I should say, that have gone from outright bearish commodities to outright bullish commodities. There's a number of other commentators out there that are now very bullish equity. So that's starting to get the ingredients of a blow-off top. So we anticipate that big push up into new highs. We've been calling new highs for the US market all year, which has played out, which is good to reflect on. But that blow-off top is what we look for, and then we look to see a rather large correction. So as we wrote this week, we're looking for a 25% correction over the next 2 years. A big call. There's no doubt about that. We're not doing it to get headlines. It's the genesis of why that will happen. We don't know at this stage. You can have interpretations of why that might happen. So you can think about US interest rates going higher or global interest rates going higher as a catalyst for that. The Trump effect wearing off. There's a whole heap of things that could transpire to have that. But our blueprint is higher into the year end. Probably start the year higher into January, and then we should be getting a little bit cautious if the market rallies too far too quickly.
Awesome. So next thing I wanted to talk about is resources. That sector's had an incredible run, obviously on the back of the iron ore price going up into the 80s. Some say it's Chinese are weakening the currency. Others are saying administrational glitches. I was reading an article in the AFR the other day about that. For investors out there that hold these stocks, bear in mind, at the start of the year we called the lows in BHP and Fortescue. Clients that have got these sort of stocks, what are you doing at the moment? What are you seeing there? Do you think it's a bit of a bubble about to burst, or how are we playing?
Yeah, we did. We got in near the lows. We didn't hold as long as we probably should have in this area. But I look at a few different barometers in the market. So the coal price, the iron ore price is obviously important. But for me, the coal price is a major barometer of the broader sector. So coal was an unloved commodity at the start of the year. Pretty much tripled in the last 12 months, and the coal producers have gone with it. We're now seeing these spot coal prices starting to roll over. Thermal coal and met coal are down around 20% and 10% from their recent highs. The contract pricing in coal is still really firm, but we're starting to see global coal companies tap the market for new equity. That's a sign to me that a top's nearing. The spot price have come back pretty substantially. So in my mind right now, there's a lot of people now turned positive on commodities. So to me, there's some interesting signs that we might be seeing a short-term top, particularly in the bulk commodity space. And I'm using coal as a barometer. You know, Whitehaven Coal is your leveraged play there. It tracks the underlying commodity price very closely. It's got about a 95% correlation to the coal price. You know, coal's rolled over. I'd expect, you know, stocks like Whitehaven Coal to roll over. So, you know, aggressive traders out there, that's a short in my view.
Yeah, fantastic. Okay, so and the last thing I wanted to talk about on the stock front is the banks. You know, we played the banks pretty well. You know, you called that ANZ, you know, $30 price target, and if you went by that, it popped its head over 30 other days, come back to just below that $30 mark at the moment. We still hold a little bit of CBA and Westpac, which we kept on revising the target upwards, which is fantastic to see. You know, targets can be revised on the way up, I guess. You know, what's the current view on the space? A lot of investors, you know, probably getting some dividends, I think, in the not too distant future. You know, how you planning?
Like the banks, but we're looking to, you know, Westpac's mid-32, we've got a $33 price target on it, so we'll be taking it out of the portfolio, or at least some of it out of the portfolio at that point. We've got a big 10% holding in Westpac, so it's one of our bigger positions. And CBA is trading, you know, $81.20 before I came down here, so, you know, higher prices there. We don't want to go out of the banks completely, but if the market does what we expect it to do, then we will be going out of the banks if we see, you know, the signs that a top is in place and a major correction are starting to prevail. So holding tight for now. Westpac nearly, you know, on the borderline of exiting that. We'll hold CBA for a little bit longer.
Awesome. So yeah, and I guess just on the other side of things, the portfolio at the moment, there's a couple of stocks that have run quite hard. And this morning you talked about, you know, moving out of Macquarie if it gets to 90, amongst some other stocks that we take profit on. You know, at the moment, anything else, you know, really compelling that you'd add to today if you had a bit of capital up the sleeve?
So we sold Ansell this week, so about a 14% profit on Ansell, which is nice to do. Yeah, there's our belief is that the last part of this bull market will be driven by those unloved stocks, the stocks that have struggled in the last, you know, 12, 18 months. There's a lot of these companies that, you know, the high PE stocks that we all know have been completely smashed. There's a lot of names out there that have been under pressure as a result of that trade. We think it's those areas that have been unloved over the last 12 months that will do well. CSL is one we've got in the portfolio that hasn't done particularly well, but we think will start to do well. Vita Group is one we've bought recently. We're up on it, but it's been sold down about 50% this year. So trading at $2.92 just before leaving the desk, wearing from the you know, lower prices there. So stocks that, you know, look, go on bottom feed is what we're typically going to be doing, and putting things in the portfolio. So sell strength, buy weakness, because it's often those weak perceived value areas of the market that contribute the most to a blow-off style top.
Yeah, and just quickly, one last one. You know, all these stocks that were perceived as high quality, high growth, you know, couldn't correct, trading at these extremely high multiples, you know, Surtax to name one, Essentia, amongst others. Bellamy's currently still in a trading hold. You know, is there anything you're looking at there? You know, I guess you'd probably call it value investing, wouldn't you? Anything you're looking at in that sort of space?
No, yeah. If they get whacked, like Ria Group, we're looking at the moment. We think, you know, lower prices, that'll get us a little bit interesting. Interesting about Bellamy's, they've gone into they've been suspended today, so I wouldn't anticipate very long. Good news from that stock. So yeah, you've got to be picky in this area. If we think the market is going to top out in January of next year or early next year at some point, then we've got to be picky about what we're going in there. So, you know, in the reports we've identified a few stocks we're looking at. The portfolio right now, we're 16% cash. Probably want to spend some of that cash into a few unloved areas of the market. So watch for alerts for those subscribers out there.
Fantastic. Thanks a lot again for joining us, James. Thanks everyone for viewing. As always, any questions, queries, comments, you can always reply to this email, or conversely, we're always available on the 1300 number, 1300 301 868. If we can't answer your question on the spot, James or I will look to get back to you. Conversely, we can always answer them in the report on a Monday. Hope everyone has a good day.